Okay, welcome back, students who are taking Math for Business and Finance and Math Applications, and we are continuing on with the Chapter 21, Stocks, Bonds, and Mutual Funds. Just two quick asides. It may seem like I'm flying through if you've been watching these videos. My apologies for talking very, very fast. I'm trying to cover a lot of information, and even though it's albeit it's just basic information. If you pick up a textbook or any kind of book, from Amazon or whatever have you, it takes several different, several chapters to be covering this information. And if you're reading that, it's going to take a lot longer than the amount of time I watch, that you're watching this video. So, yeah, I'm trying to get through it as quickly as I possibly can. So I am talking, kind of fast, but you do have the ability to be able to pause and rewind and watch the video again. And if you still have any questions, speak with an instructor. All right, so um, we covered stocks in those last, 5 videos. And so now let's jump on down here to bonds. Now, bonds are a little bit more complicated than stocks. I can't say more complicated, they're just different, okay? But I really only have 2 slides to go through. I'll have one for bonds and I'll have one for mutual funds. So, bonds will be basically 1 or 2 videos, I think, and mutual funds will be another video. But let's just get to it. Okay, so bonds. All right, first of all, what is a bond? A bond is a promise to owe. Okay, now there's a variety of different kinds of bonds. You know, when you hear about T-bills, right? T-bills, all right? Treasury bonds, right? These are kind of, what the government, you know, uh, the bonds that the government are selling between different countries. Like you're hearing about, oh, how China buys up, our bonds. Well, what they're doing is they're buying our bonds, and as you'll see, the bonds are a promise. They're like almost a promissory note. They're almost like a bank loan. Okay, and you'll see what I mean when I as I continue on with this. But those are like the common ones that you've seen. They're for different amounts of time and different terms. Um, you might have heard of something called like a municipal bond. Municipal, right? That might, a municipal bond is something that maybe your city decided to quote unquote what they call float, okay, put out there for people to buy, right? Municipal bonds, are generally, you know, safe bonds, and they use that money for investing in the city, whatever have you. Bonds can also be created. Let's say, for example, you have a college or a university, and they want to build a new building for, say, the science wing. Okay, well, they need the money. So how do they do that? They can, go on fundraisers and things like this to try to get the money, or they can float bonds. Okay, they can just have a bond and sell the bonds in order to be able to raise the money. Why? A bond is a promise to owe, and generally they're sold in $1,000 increments. Okay, and what ends up happening is when you buy them, you're buying the $1,000 bond, and now this is going to go back to the time value of money chapter. Okay, let's say this science wing, just to give as an example to keep it simple. Okay, let's say the college university, they need to raise say $7 million. Okay, and they decide that they want they're going to float bonds, so they need to raise $7 million, and so they're going to float bonds. And what they'll say is okay, today's interest rate, let's just say today's interest rate is 1% in the bank in your savings account, right? Well, what they're going to do is they're going to say, okay, look at, if you buy our bonds, the bonds are $1,000 bond, okay, and that's generally the way they're sold, even though they can be sold for $100 or things like this, okay, but for the most common types are 1,000. What they'll say is okay, you'll buy $1,000 bond, and we'll give you say an 8% return, an 8% in interest per annually. Okay, and that'll be paid in 2 payments, so in every 6 months. Okay, and that bond will last, say, let's call it a 5-year bond. Okay, so you're sitting there going, well, if I have $10,000 in the bank, right, and I'm only getting 1%, maybe it makes a good sense for me to buy this bond. Now remember, there is always risk, okay? Because why? What if the college goes out of business? Highly unlikely, okay? But there is that possibility, and that's a risk. But you're sitting there saying, that college has been around for 20 years. They're expanding. I know that the student population is going up. They're not in any kind of trouble. Like I don't want to say, name one particular college that we see in the news an awful lot lately with their fraternities and stuff, things like that. But anyway, you say, okay, instead of me having my money in that savings account getting nothing, let me go and buy the bond, right? So what does that mean? Well, you're not buying, you on the surface you might think, well, I have $10,000 and these bonds are 1,000, so I'd buy the 10 of them. Okay, 10,000 divided by 1,000. It doesn't work that way. What ends up happening is you go and you figure out the present value of a dollar, the present value of that $1,000 bond, and let's say at 8% over 5 years, let's say that comes out to say $650. Okay, so you're going to end up, spending $650 for a $1,000 bond. All right. Now, and you have 650, and if you have 10,000, you figure, well, if I buy 10 of those, that's going to cost me $6,500. Okay, and so you're going to give the college $6,500, and they're going to give you 10 bonds. Okay, 10 $1,000 bonds. Okay, and during the course of the 5 years, you're going to get 8%. Right, so 8% of 1,000 is $80 a year. Okay, let me find a place. So you're going to get $80 a year in interest. That's $40 because it's every 6 months, right? You're going to get $40 every 6 months for that one bond. Okay, and now you've got 10 of those, right? So you're not getting the $80 a year, right? Yeah, you're getting the $80 in interest for one bond, but you have 10 of them. So you're getting $800 a year for those bonds, or $400 every 6 months. Okay. Now, at the end of 5 years, okay, you're going to get your $1,000 back on that bond. So you're going to get that whole $10,000 back. I'm sorry, you're going to get $10,000 back because you bought 10 bonds at at $1,000, right? So you'll get the 10,000 back. Right? So in the grand scheme of things, let me erase all of this. In the grand scheme of things, these were $1,000 bonds at 8% for 5 years. Okay, you're buying 10 of them at the $1,000, right? That means you're going to get back $800 per year in interest. And at the end of the 5 years, you're going to get back, 10 at 1,000, or $10,000. Now your cost for doing that, again, when you looked at the present value and you factor that in, the present value of that bond is 650. So you're buying 10 of them. Your original cost is what you're investing is $6,500, and you'll be getting that $800 in interest every year. And at the end of the 10 years, you'll get back the $10,000. So that's your return on investment. And that's the way bonds work. Okay, it's basically an IOU. It's like a note. You're lending somebody money, and this is what you expect to get back, and the risk is your chance of default. Okay, that's why like municipal bonds, okay, are good because that's backed by the city. T-bills, treasury bonds backed by the U.S. government. At one point in time, they were considered the safest in the world. Okay, and right now that's a little bit questionable, but that's beyond the scope of this textbook. Okay, so that's what you're looking at when you're buying a bond. Now, a lot of the things I just spoke about, the cost of the bond is $1,000, and that they call that the face value. Okay. Now, it is possible for bonds to go out to end up on the secondary market. Okay. What does that mean? They can be traded. I mean, treasury bills, T-bills and treasury bonds, right? Foreign countries are buying our bonds, and those bonds end up on a secondary market, as an example. Okay, and when that happens, whatever the face value of the bond is, it's considered 100%, or it has a price, for lack of a better word, a stock price of 100. Okay, that's how we talk in terms. It's not like the price of a stock. I mean, it is and it isn't. Bonds start out at 100 as the benchmark. Okay, whereas the stock price can start out at 33 bucks, it could start out at $15, it could start out at $1, it could be any number, okay, as a price. But for bonds, it generally starts out, and it starts out being at 100, okay, and then since it's on the secondary market, those bonds get bought and sold. So if it starts out at 100, okay, and it's being bought or sold, well, the price can go up and the price can go down. If the price goes up to say 103, okay, that means it's being sold at a premium, meaning you're getting $3 in premium, 103 less 100. But if it goes down to say 98, right, it's spoken of as trading at a discount, okay, meaning you're losing $2, the difference between 198, right? It's trading at a discount. Right? So if you're understanding that, that's what I have here next. A 10% bond closing at 103 is 103, 10% being the interest. Okay, so 103 times 1,000 is 1,030 times however many bonds were purchased. So you're getting like $30 in addition because it's trading at 103. That's the premium. Okay, and if you bought 10 of them, right? Well, 10 times the 30 is 300 is what your actual premium is going to be on that particular bond. And of course, it goes in the opposite direction when the price goes down to like 98. Okay, remember, it starts out at 100. So if it goes down to 98, now it's trading at a discount. Somebody may buy it at 98 because they feel it's worth 103 and it's going to go up and they'll make the 5 points on it. Okay. All right. Let's see here. Yeah, I can cover all of this in the next couple minutes. And so I'm just going to make this just this one video instead of breaking here and making 2 different videos. Okay. Again, if you don't understand this, watch the video again and feel free to contact an instructor. And I know I'm going relatively quickly because I am trying to cover a lot of material. It is in the textbook, but again, I'm trying to go through quickly. Right, so our yearly interest is the face value of the bond times the stated yearly interest. So the face value of the bond is 1,000, but this bond is a 10% interest. So my yearly interest is the 1,000 times the 10%, or $100 is my yearly interest on the bond. And if I have 10 of those, or let's just say 6, right? that means I'm getting $600 in interest per year, okay, because I have 6 bonds. Okay. Bond yield is the total annual interest divided by the total current cost of the bond at closing. Okay. So and I made a mistake on this here table, right? This here volume here should have been, let's see, 214, 587. Doesn't matter. Okay. I'm not going to get into this calculation of the bond yield, which is what you're seeing here. Basically, know that you're talking about your total annual interest, and you're dividing it by the total current cost of the bond at closing. So you're talking about the total current cost of the bond, and that's beyond the scope of this textbook, so don't worry so much about it. Just realize that you're taking the annual interest and dividing it by that in order to get your current yield. The reason why I'm pointing that out is because this is the way, just like stocks are presented in the newspaper, so are the bond prices in a newspaper when we're talking about the secondary market. Okay, meaning where you can buy and sell bonds versus just like you buy and sell stock. They're presented, the bond, it has a name, okay, and it presents the current yield, and that's probably the most important thing, is what your current yield is, because like I said, it's this is pretty straightforward, cut and dried, in that you're kind of like buying a bond expecting a solid return. You're not really looking for appreciation like you do with a stock. I mean, with a stock, you're looking for the price to continuously go up. You bought here, you're selling up here, you're looking for appreciation here. Whereas with bonds, you're really, not so concerned about the appreciation, because bonds really don't trade. You're not going to buy, say, Amazon at $10 and it goes up to 360, okay, and then splits, and it goes up to 360 and splits again, and that's all appreciation. Bonds will have a tendency to remember, it starts out at 100, it'll go up to 100, 106, 110, or it might go down to 98. There's not that much of a swing between the two. Okay, so you're really not purchasing bonds for appreciation value. What you're purchasing bonds for is more of a steady return on investment. So you look at your current yield, okay, and saying, okay, I'm getting 4.02%. If I'm only getting 1% in my savings account, obviously I would want to buy a bond. Okay, now granted, in the savings account, your money in there is FDIC insured, right? Meaning if the bank goes defunct, the federal government, quote unquote, backs it, which means you should get your money back. But that's even a risk, because we know that there's been, runs on banks. People lose their money putting into a bank. But theoretically, that's supposed to be secure at 1%. If I'm going out here and I'm buying a bond, I'm getting a greater yield. Okay, I'm making a little bit more than 3% more on my bond. Okay, and versus having it in the savings account, so that makes it a better choice. But you also have to consider the risk, whether that bond is stable. Like I said, for a college or university, or your local municipality, if you're at your city is a profitable city, you might want to consider that, because there's a lot less risk involved in owning the bond. Okay, and you get a higher return on your money instead of sitting it in the savings account. Again, this is 214, 587. And of course you have the closing price. Again, if it's traded on the secondary market, that price will go up and down. And of course the net change is the change from the day before, meaning if today's price is $99.50 and it's down $1, right? That means yesterday it was 150, because now it's down, just like with the net change in the stock price. So that's how they quote them in the newspaper, and that's pretty much everything we need to know for bonds right now. But remember, whether it's stocks or bonds and mutual funds, kind of get this stuff under your belt right now, because you will see it again in future subjects. I sit there and I go, I'll be talking to an intermediate accounting student, and it's like, well, you've already had this, 2 or 3 times, and you still don't know this information. Why? Okay. Well, this is, for a lot of people, this is the first time that they're seeing this information. So start trying to know it now, all right? Not memorize it, understand the concepts, because you'll get a lot of practice doing these things, not just in this subject, but future subjects. Okay, so with that, I'm going to stop, and that's going to cover bonds, and I will pick up with mutual funds in the next video.